so much, Andrew, and a pleasant good afternoon to everyone. I will be talking about a very interesting, groundbreaking topic. We've been talking about in the past couple of days the how to scale up renewables to accelerate the energy transition. I'm here to talk to you about a little bit about that, but focused on the aggressive or methodical retirement of coal plants. I think it's more natural in a place like Australia. Paul talked about the transition that's happening there. A lot of the coal plants in Australia are 40 to 50 years old or approaching that age, the retirement age. Average coal plant retirement age is about 50 years in the US. The issue with the Philippines, Indonesia, Vietnam is that we've got a relatively young fleet. A lot of coal plants were built in the mid-2000s, 2010 onwards, some in the late 90s, early 2000s. So we've got coal plants that are 5 years old, 10 years old, 15 years old, with a long way to go. So I think that is the gist of this presentation. But first, let me provide a very quick summary of who ACEN is. ACEN is the renewable energy platform of the Ayala Group. Ayala is one of the largest and longest standing business groups in the Philippines. It's celebrating its 189th year this year, amazing longevity. But ACEN is one of the youngest companies. I was the founder CEO of ACEN 12 years ago. In 2011, we started this from a standing start from 0 megawatts. We were a latecomer in the industry. We started focus on thermal and in the Philippines when we started 12 years ago because of the lack of competitiveness and scalability of renewables back then. So we enabled around 2,000 megawatts of greenfield coal plants in the Philippines and owned about half of that. But in 2016, when we were at more than 1,000 megawatts of coal and less than 100 megawatts of renewables, we began a strategic pivot as ACEN. Back then we were known as AC Energy. We saw the world changing and moving more into a more sustainable future, but it wasn't an easy decision for us to start getting out of coal and putting all our efforts into renewables. And today, I think that all that effort has been paying off. We are now at 4,000 megawatts of renewables. 60% of that is under construction and 40% is operating, but a lot of those megawatts are going to be operational in the next 12 months, which is a perfect time to be starting operations given the tightness in supply in the markets that we serve and the global energy crisis and so forth. So we're present in 5 countries today, so we also expanded our geographic footprint. Philippines remains our core market, but we're also present in Indonesia, Vietnam, India, and of course, Australia. So it's really an exciting time. We're focused on solar and wind, have a strong balance sheet. Last August, we just announced our 2030 aspiration, which is to reach 20 gigawatts of renewables by 2030. So that represents a 5x growth versus where we are today. Now, part of our portfolio today, we have a large renewable concentration of 98% at the ACEN listed company level. But the reality is we had to do something about our coal and thermal assets. And when we went through this divestment program, one of the pain points or issues that were raised by our ESG-oriented investors is, while divesting coal is a good thing and reinvesting the proceeds into renewables expansion, aren't you just passing on the problem, the emissions problem, to somebody else? Especially if it's an unlisted company taking over the coal plant, they will have less discipline, less disclosure, less transparency, and will run the asset up to almost forever. So we said, you do have a good point, but we cannot just switch off the plant. That would also be an irresponsible thing to do, but if we kept it, you won't invest in us, and therefore, how can we really expand? So that was a dilemma that we were facing until the ADB pushed really the concept of the energy transition mechanism about a couple of years ago, and that gave us really an aha moment. and we said we love the concept. Maybe that's the answer, that there are purpose-driven investors out there willing to put money into coal with the purpose of retiring the coal plant earlier than its operating or technical life. So that was the key concept. That was an aha moment for us. So we moved quickly. The last G20 meeting in Indonesia and COP27, gathered a lot of momentum, a lot of talk and commitments on the so-called JETP or the energy transition mechanism. And we are just so delighted that we were able to financially close the world's first ETM. Yes, it's all private sector driven. It's a market-driven transaction, and we would love to share with you our insights and learnings. I can guarantee you it was not easy, right? So the transaction entailed the commitment to retire the coal plant at age 25, thereby avoiding 25 years, up to 25 years of emissions, given that coal plants typically live until 50 years. At 2 million tons of emissions per year, that's up to 50 million tons avoided. So it's not a big plant, but it's a good pilot, a good case, a proof of concept that it can be done. I wanted to share with you the 5 key components or key drivers, if you will, that led to this first ETM transaction globally. Number 1 is really obtaining key support from the stakeholders. We cannot understate the importance of this. And of course, optimizing the capital structure, allocation of risk, and also looking at the broader issues of energy transition, applying a just energy transition are also critical from a sustainability standpoint. And again, creating more opportunities in this space as we have to decarbonize and decommission a lot of coal plants globally. So I think these are the components I wanted to wish to share with you today. On the first thing, obtaining support from key stakeholders, I think we're also fortunate that Ayala Group, our parent, committed to net zero GHG emission by 2050. ACEN also did commit to that since last fourth quarter of 2021. So we were already predisposed to do the right thing, and I think it was a relatively easy sell to the board to embrace this mechanism. We remained as the off-taker, so we moved essentially our emissions from Scope 1 to Scope 3 because we do acknowledge that we are serving customers and we still need the output. But our ESG investors understand very well the difference between owning an asset versus just buying and selling the asset, the difference between Scope 1 and Scope 3 in our sector. This transaction also allowed us to recycle the capital. It generated liquidity and allowed us to recycle and support our very aggressive renewables pipeline. But I think what's key also is to convince the anchor investors, particularly the banks and some of the equity investors, including the insurance companies, that this is a good thing. And the irony of this is our anchor investors are banks that have a policy against lending to coal. They're the first 2 banks in the Philippines, RCBC and BPI, Bank of the Philippine Islands, have a policy of not lending to coal plants any longer. So they needed to go back to their board and have a carve-out of their policy. It's not easy, and that's one of the barriers, I think. Even if it's a novel concept, it's not easy because one needs to go back to the board to have a specific carve-out. Because after all, the ETM is still financing coal plants. One has to be convinced that there's no greenwashing any involved or a just kidding mentality in there. The structure has to be robust and believable. So I think this is one hurdle that we were able to overcome. And of course, the workforce, myself and the management team had to be there explaining the concept of a just energy transition. I think managing the key stakeholders is extremely important if we are to be successful. In terms of the capital structure, which is the second key driver, the lowest, so again, this transaction did not require the so-called blended finance. I think there are opportunities for blended finance. I think there's also opportunities for carbon credits, which I can cover later on. But this is really a market-based transaction. And as we all know, the lowest source of capital is debt. So this is akin to a leverage buyout. We optimized the balance sheet of the asset and re-levered it using, again, structuring the deal to make sure that we are maximizing the leverage ratio. So we were able to increase the debt in this particular case from 10 billion pesos, or about $200 million, to about 13.7 billion pesos. So we were able to refinance the existing debt and upstream the balance to pay ourselves as part of the proceeds that we will then recycle for our renewable projects. The balance that now shrunk the equity value, we made sure that we had the right structure so that the insurance companies who would love these long duration cash flows but stable earnings on almost on a yield basis, we structured a preferred equity that was attractive to these insurance companies. And then there's minimal common shares which took the risk, but again, the way we structured the power purchase agreement was in such a way that there was limited risk. It's more of a tolling arrangement where it was a cost-plus structure in terms of the PPA. So I think there's a lot of devil in the details, and I will not bore you with the details today, but I think getting the right structure and allocating the risk, and I think a lot of you are experts in risk allocation, is critical in getting this thing right. The two critical agreements underpinning the contracts between SLTech, the power plant, and ACEN, which is the off-taker, is again the administration, what we call the AMA, or the Administrative and Management Agreement, which is AKA Power Purchase Agreement, as well as the O&M supervision. Of course, while the 200 people workforce of SLTech coal plant came with a transaction, with a divestment, the investors wanted to make sure that there was enough quality oversight and supervision to make sure that the plant continues to run safely, reliably, and efficiently. And so we had to structure an O&M agreement with ACEN as well. So again, there's a lot of elements of identifying and mitigating the risk to make all of this clear for the various investors. And then, of course, implementing a just energy transition, looking beyond the deal structure and so forth. But we are operating within a system that is encountering very tight supply. Philippines is no different than Australia, which is experiencing tightness of supply of base load and reliable power. So we need to make sure that we manage this transition properly. So part of our mandate is to scale up reliable renewable power in the Philippines by investing aggressively in solar and wind and starting to incorporate energy storage into our mix. So the numbers are not that difficult. To replace 246 megawatts of coal, we would need to build around 1,000 megawatts of solar and wind and the requisite energy storage to make it reliable. But relative to our 20 gigawatt plan, of which 40% roughly will be in the Philippines, we are more than covered in terms of the capacity that we will be losing in the next couple of decades when we retire the coal plant by 2040. Of course, the workforce evolution is something that we are taking seriously. We are still part of the O&M team so that we get to rotate and upskill. There's a lot of commonality between the thermal jobs and the green jobs. There's mechanical engineers, electrical engineers, civil engineers. In fact, I think thermal is much more difficult and sophisticated than renewables, especially solar. So there's a lot of transportability of skills, and this is not too much of a concern from that standpoint. The community will lose a lot of revenues once we shut down the coal plant, and that needs to be addressed, and we're working together with the local community, the local government, to make sure that we have the right path to address the transition to other revenues. And of course, collaboration and transparency is key. We work with our regulators and so forth to make sure that we are coordinating properly so that the grid doesn't lose capacity that we very much so need, and also to cascade the learnings that we have given the strong interest regionally and globally in terms of making energy transition mechanism a reality. And to that point, I think there are a few key learnings that's worth cascading beyond the Philippines and beyond the region. Number one, I think, again, similar to Australia, there has to be a more structured and less unpredictability in terms of when these coal plants will be retired. I think in Australia it's relatively easier because they have no choice because of the older coal plants. Frankly, it becomes economic in nature. But as I mentioned, in the case of the Philippines or Indonesia, we have much younger fleets. You have to be more purposeful in terms, and it's a tougher decision to decide to shut down a coal plant, and you just don't do it in a whim. You have to give time for the industry to plan for it. So I think hopefully we can show that it can be done, that it's the right thing to do if we are to encourage more clean replacement capacity, whether it comes from renewables, from gas, or other cleaner technologies. I think the second realization here is I think while we were successful in terms of driving this through a market-based mechanism, private sector funding, I think there's opportunities to tap blended finance, and that's what the whole JETP initiative is all about, as well as carbon credits. I think carbon credits has a significant role to play here. We talk about credits that can be attached to carbon capture and storage projects, for example, which reduce or eliminate emissions caused by coal or gas. But what about those 2 million tons of emissions that we will be avoiding because we will not be running the coal plant? What if we can shut down the coal plant earlier? And by the way, in our structure, we did give ourselves the flexibility. We awarded ourselves a call option to be able to own the coal plant anytime between 2031 to 2040. Why 2031? Because we have an obligation to our customer, the Meralco, the distribution utility, until 2030. So it is not actionable. We cannot shut down the coal plant. But in theory, we could shut it down in 2031 when it's age 16. But I would only do that if it made financial sense to us. And if we can demonstrate to the carbon markets that, hey, while we have committed to shut down the plant at age 25, I don't expect any credits between 25 to 50 years old. At least if I'm able to shut it down at age 16, don't we deserve this carbon credit and incentivize us to shut it down earlier and transition it to a cleaner technology? And by the way, in our call option, we will have to pay a reasonable amount to the current owner to take back the plant, not only to shut it down, but we can then use the connectivity, the grid connectivity, and that is very valuable. One of the key constraints in our industry right now is the lack of transmission, and I think Paul was quite clear in terms of the need to scale that up, not only generation side, but also transmission. So that is a very scarce resource that we would be owning back if and when we exercise that call option, and it could be much earlier. So I think the opportunity to incorporate this in carbon credits, if nature-based solutions are fetching at significant premium over renewable projects, surely early coal retirement would also arguably fetch or deserve a significant premium. And I don't mean 45-year-old coal plants being retired, 5 years ahead of the average 50, that would be too cute. But retiring 15 or 25-year-old plants, I think, deserve some credit for that. So that's a work in progress, but I think this is another huge opportunity. So the work is not over yet. We continue to improve on the structure, and we have the flexibility to do so. So in summary, a lot of good things that come out of this. One is obviously the liquidity and the ability to recycle that capital to support our aggressive renewables expansion, the avoided emissions, depending on your belief in terms of how long this coal plant would have run if we didn't do this mechanism. And of course, the zero coal ownership from a platform perspective is also quite valuable, because now that we have formally divested our remaining coal plant, a lot of ESG investors are now willing or able to invest in our listed platform and again propagate our aggressive expansion of renewables. So truly an exciting thing. The dynamics are quite nuanced. There's a lot of learnings. There's going to be a lot of challenges. It's actually heartening to be invited. I think in Indonesia, we are briefing the various advisors and aspects of the Indonesian government and policymakers to really understand the details of this groundbreaking transaction. So again, I know we don't have enough time. We don't have a Q&A, but in the coffee networking break, be happy to address any questions. But in the meantime, I'd also like to leave you with a short video of the company, because not only are we transitioning away from coal, but we are going all in on renewables, and wanted to give you a glimpse of what ACEN 2030 is all about. Thank you so much, and have a pleasant good afternoon. This is about reimagining the ACEN journey. We've grown tremendously over the last few years, and yet the world is just at the beginning of the energy transition.
We are now in a climate crisis. The world is shifting to cleaner technologies, but not fast enough. This is a wake-up call to accelerate the energy transition.
The entire organization is fully committed to ACEN 2030. ACEN 2030 is our vision to reach 20 gigawatts of renewables by 2030.
The supply from the country's major gas field is declining, and the industry is heavily reliant on coal imports, which have become expensive. Energy security is a key risk, and it's imperative for the Philippines to accelerate its renewables build-out.
Vietnam has significantly scaled up solar and wind over the last few years, although the grid is now challenged to manage all the intermittent capacity. Power demand is also staging a strong recovery, and soon the country would have to resume its renewable expansion and incorporate energy storage.
The energy transition is in full swing in Australia. Most of the coal plants will be retired within the next 2 decades. We expect much of this capacity to be replaced by renewables and energy storage. Australia aspires to be a global leader in green hydrogen exports, which will require massive scaling up of renewables capacity.
Scaling up renewables won't be easy. On-demand availability will be a key challenge, so we need a significant buildup of energy storage to unlock the potential of renewables. We expect land and transmission limitations in most markets, so we need to start leveraging new technologies, such as floating solar and offshore wind.
Partnership has always been in ACEN's DNA. While we build our organic development capabilities, we will continue to work with various partners to accelerate our growth.
Dreaming big and having strong conviction that we will succeed, this is the ACEN way. Will we make it?
Well, we've consistently delivered in the past, so yes, I believe we will.
I believe that it's not a matter of whether we will get there, but rather how fast we will get there.